Welcome to the cutting edge of the global awakening.
In the councils of government, we must guard against the acquisition of unwarranted influence by the military-industrial complex.
Well, it looks like the North Tower of the World Trade Center has just completely collapsed.
The U.S. dollar's status as the preeminent reserve currency is under attack.
This is a mathematical fact. Tens of trillions of dollars are being extracted from the United States of America.
You really want the truth? Then just follow the money.
Welcome to Follow the Money Radio, a broadcast dedicated to your personal, spiritual, and financial liberty. And now, here's your voice of reason in the midst of global chaos, economist and best-selling author, Jerry Robinson.
Friends, welcome to this week's broadcast. So glad that you're joining us. Glad you tuned in. Follow the Money Weekly Radio. My name is Jerry Robinson, your host, your guide, leading you on an excursion to truth. And what a word that is in these very deceptive days. What a unbelievable mess we have ourselves in here when we take a look at the debt levels in the United States. Of course, over $16 trillion now, nearing $17 trillion in national debt. And then, of course, the unfunded obligations. I was just reading earlier in the week that a large number of federal workers are soon going to be retiring and demanding their pensions just at the time whenever we are having all of these financial crunches in Washington, D.C. Of course, we're always having problems with money in D.C. because they can't seem to manage the money at all. But we are seeing certainly a crunch in both federal pensions and, of course, pensions across the country. Then we have to factor in the unemployment levels. And then if you take a look at the globe, we're going to provide you with a quick update on that. I have a report here from the World Bank talking about how they're cutting global growth forecasts for the year. So it is a very volatile time. And whether you're a stock investor or whether you're a real estate investor or whether you're a small business person, or maybe you're just an aspiring investor, someone who wants to eventually put money into the capital markets or into real estate or your own business, you simply have to follow the money, as we say. You have to be very aware of what's happening. Now, all income flows from those three things that I just said. The capital markets, or we should say paper assets, and then there's also real estate, and then there's also your own business. In fact, if you think about all of the jobs that you've ever had, you've worked for someone who either A, started their own business, or B, you've been involved in some sort of real estate, or C, you've been involved in paper assets. I mean, those are the only three asset classes that throw off income. That's where all income streams are created. So those are the three areas that we focus on this program. Certainly investing in the stock market has been, over the last several years, ever since March of 2009, the market has been going up, but it's been very treacherous along the way, lots of ups and downs. But overall, we certainly have seen a climb out of the bottom of the barrel. Real estate has done the same thing in many ways. However, it also has had some hiccups along the way. We're going to talk a little bit about real estate later on in the program and just some ideas. And then we're also going to have Tom Cloud on. He'll be here to provide our regular precious metals market update. John Burrs will be here with his retirement minute, and Jay Peroni will be here with his stock investing idea of the week. But let's just take a look at what happened in the markets this week. Markets around the globe dropped this week on concerns over potential monetary tightening by global central banks, including the Fed. The fear is that the Federal Reserve may soon begin tapering off their QE efforts. Now, I was reading earlier in the week, and Jeff Bullard, who's the St. Louis Federal Reserve president, he was speaking, and he said that inflation below the central bank's 2% target may warrant prolonged aggressive use of bond buying to spur growth and bring down unemployment. Remember that the Federal Reserve has set a target on inflation. It wants to see inflation at a certain level, and because inflation has been surprisingly low when you take a look at the official government numbers like the CPI, there's still a lot of room for them to continue printing money. But that does not mean that the market participants and the financial news media is letting it go that the Fed may begin easing as of this year. In fact, we've even had hints dropped by Ben Bernanke himself that the goal is by the end of the year to begin tapering off, not stopping it completely, but slowing it down. And when you realize why that is scaring the markets, it really brings the point home. Because the Federal Reserve, by printing money, buying bonds with the money, is in essence staving off what should have been a very normal correction and probably a depression back in 2008. They intervened immediately and they said, look, we saved the market. Look, we did all these things. But when you take a look at what they did, it was almost as if the cure was worse than the disease. The disease, in fact, was treated with more of the same disease, more debt. So they're trying to fight more debt with more debt, with more debt, with more debt. And in the end, it's all going to be a big mess. I mean, it's just a matter of time. Japan, by the way, is another place for investors to keep their eyes on. It certainly has been an easy place to make money over the last, ever since last November, I guess, when the market really began taking off. But it certainly got difficult over the last several weeks, as just the last 2 or 3 weeks alone, Japan has nosedived all the way down 20% in a very short amount of time. Since that occurred, the Japanese market has been trying to come back up. The preferred way that I like to invest in Japan is the ticker symbol DXJ, and that is a Wisdom Tree hedged Japanese equity ETF. And that's how I like to play on the way up, when the Nikkei is moving up. When the Nikkei begins moving down, Japanese market begins moving down, I like to use the ETF EWV, and that is an inverse ETF on the Japanese market. Use those with caution, and of course always talk to a trusted financial advisor before you use any of our recommendations here or take them as recommendations. We are simply providing you with our own ideas. The Federal Reserve says that, or at least Bullard is saying that there's probably going to be more action down the road. We'll see about that. We'll see if he's right or not. We also have the World Bank cutting the global outlook amid hesitant and uneven recovery. Here's the story. The World Bank cut its global growth forecast for this year after emerging markets from China to Brazil slowed more than projected, while budget cuts and slumping investor confidence deepened Europe's contraction. Europe is certainly dealing with a lot of pessimism. In fact, I got a report from Axel Merck, who is one of the top currency strategists in the world, and what he was basically saying was a lot of good news have been built into the U.S. dollar and a lot of bad news have been priced into the euro, and therefore he's buying the euro currently against the U.S. dollar. Now, the euro we did name as one of our favorite currencies for the quarter, or actually for the year, in our previous FTM quarterly newsletter. For those of you who received that, we are bullish on the euro long term. And when I say long term, I'm talking about over the next couple of years. We think that it'll actually do better than the U.S. dollar. And that, of course, will remain to be seen. We'll keep our eyes on that. Don't know if you know this, but over $2.5 trillion evaporated in the value of global equities since May 22nd. What happened that day? Well, Fed Chairman Ben Bernanke said that the Fed could scale back stimulus efforts if the employment outlook showed sustainable improvement. And ever since May 22nd, since he made that statement, the markets have been having a very difficult time, as there's a lot of tension and a lot of concern that the Fed is going to stop the money pump. Now, there's not a whole lot of reason to believe that they're going to do this. We don't have a lot of good economic data flashing telling us that we should see this. In fact, if you take a look at the U.S. economic data just this week and just over the last several weeks, we've seen some pretty negative stuff. Our U.S. manufacturing activity recently hit its lowest level in 4 years just last month. And there's no doubt that that's a problem. In fact, U.S. manufacturing activity is actually contracting currently. And we also take a look at the unemployment level. It does seem, if you look at the overall charts of unemployment, it does appear that the U.S. unemployment level is easing, and it's certainly looking better. But if you take a look at the U6 rate, and that's the rate that includes those discouraged workers who have given up looking for work, then we actually saw the U6 rate rise in May despite all of the other glamorous news that they tried to put on the face of that pig. Put a lipstick on the face of the pig when they provide these unemployment numbers. They put them out and they get all excited about them, but when you really look underneath the hood, you realize how negative our economy still is, unfortunately. And businesses are not hiring the way that they have in the past, primarily because of uncertainty over government action. And one of the major things that many business owners are looking at in their hiring decisions is Obamacare. Obamacare has a lot of employers worried and scared, and rightfully so. I mean, there have been reports put out about Obamacare and the potential effect that it's going to have. We saw Walmart, who normally only hires temporary workers during seasonal times like Christmas time and things like that. They're actually hiring temporary workers just regularly. There was a big survey done of many different Walmart stores in each state, and the findings were that we are seeing temporary workers hired by Walmart for the first time ever, not during seasonal time. So that's just more proof that we are seeing Obamacare putting pressure on American businesses. And in fact, it's not surprising. A new CBO report, the Congressional Budget Office, provided some updated numbers on Obamacare. By 2023, according to the CBO paper, Obamacare will still leave 31 million people without insurance. 31 million people in America will be without coverage underneath Obamacare by 2023, despite the fact that Obamacare will add nearly $1.8 trillion in new federal spending. So we have Mr. Obama saying, well, we need to have Obamacare, we need to push this through, and nevertheless, it's not really translating into what he has promised. That's a typical politician for you. Obamacare will add an estimated 13 million people into the failing and broken Medicaid program. That's not good. 24 million people will obtain coverage through the law's exchanges, 19 million of whom will have their coverage subsidized by the government. 7 million are expected to lose their current employer-sponsored coverage, despite the fact that President Obama said that that would not happen, made a promise that that would not happen. And about 5 million people will no longer obtain their coverage in the non-group market. So we have a lot of uncertainty with Obamacare. The folks in Washington, D.C. are not making things easy on business by any stretch of the imagination as we look out and check it out. Now, U.S. stock investors who have been waiting for a market pullback here in the United States, the S&P, the Dow, the NASDAQ, well, they're certainly getting their wish. Technically speaking, U.S. stocks still remain in a 6-month uptrend if you take a look at the chart. However, it's not quite the right time, in my estimation, for wise investors to begin taking on new positions, as this market remains far too volatile in the short term, and there are plenty of catalysts that could send the market down even further. Earlier in the week, we changed our red, yellow, green light system to red. Our subscribers received the real-time alert. They received everything that I was doing as far as my own trading ideas and my own personal trading accounts, and I let them know exactly what I was doing based upon the information that we had. And we did turn the light red, indicating that there is danger ahead. So be careful in these markets and tread very cautiously. The S&P, and I'm talking about the Standard & Poor's, this week raised the nation's credit outlook to stable from negative, easing concerns of a potential downgrade. It's all kind of a rigged game, so you have to be careful as you're investing in these markets, as I've said over and over and over again. But once our market conditions light turns green and it moves back into a confirmed uptrend, all of our FTM insiders will be alerted in real time by email, along with some of our favorite stocks to begin buying. Because many stocks right now have been sold off fairly hard, and they are moving into attractive valuations. And so during times like this, whenever the market is volatile and we're moving to the sidelines with cash, we want to be looking for future positions to take and creating a wish list of stocks we would like to own for the next rally up. everything goes up and down over and over and over again. All over the world, we see the same thing. The stock markets go up, and then they go down, and they go up, and they go down. And unfortunately, from our perspective, we realize that most of the up is determined by fake money that's being pumped into the system, and the downs are created by the fear that is created by that fake money being put into the system and whether it'll continue. So it's an absolute insane market that we find ourselves in. It's just unreal. Emerging markets, by the way, except for a very few select countries, which we have put into our ETF cheat sheet for all of our FTM insiders, which you can see, do not look good currently, as we've said. Emerging markets are not looking positive right now. Over the last 2 weeks, shorting the emerging markets has been a very profitable venture. The ETF I like to use for shorting the emerging markets is EUM, ticker symbol EUM. I've certainly used that in the past and recently to make money as the emerging markets go down. And I expect we're probably going to see that continue, that trend. Other news, I've got a whole lot of news here. I don't want to cover all of this because I do want to get Tom on and talk about a few other things. I want to talk about real estate before we move to that. But I got a few more stories here. First of all, I've got to comment on this PRISM deal. The NSA, the whistleblower, Edward Snowden, who is now hiding out apparently in Hong Kong, exposed and cracked wide open the fact that the NSA and many of our government institutions are heavily involved with internet surveillance. And according to the report, they have been working together with Facebook, Microsoft, Google, Apple as of late, Yahoo, YouTube, AOL, and Skype. And they began this PRISM surveillance program at least 7 years ago. So they have been watching us. They have been tracking and tracing your phone calls, databasing much of your information, cataloging it. And we've been telling you this for a long time. You know, this is not something new. This is why I had such a reaction that I did to the Boston bombing and the unbelievable 1984 Orwellian type of response that we saw in Boston. You know, my basic thesis is that when you put this much power and you invest it in so concentrated form into just a few hands, things don't end well. That doesn't go right. Spying becomes extremely easy, and that's exactly what we are seeing. And I've seen many calls this week. I've gotten a lot of emails saying, quit Google, quit Facebook, quit YouTube. Well, you know, sure. But it's not just those websites they're tracking you through. That's the part that many people are not getting. They are bringing down the noose. This is so obvious what they're doing here in the United States at the highest levels. They passed the Patriot Act after September of 2001. They passed the NDAA, which was an absolute travesty. And we had men on the stage during the presidential campaign, and I say men, there was actually one man who stood against all of it, Ron Paul, and he said, we need to stop this. And the American people said, but we want to keep fighting wars. We want to keep, he doesn't want to fight wars. And of course, what we say to that is that he also wanted to end the Fed. And everybody thought, well, that's kind of a good idea. But if you end the Fed, you don't have money to fight wars because they're the ones who print the money. So anyway, the American people are kind of getting what they deserve, in my opinion. I tell you, to be totally honest with you, this has been going on for a long time. This PRISM story that I'm looking at right here, this is not news. This is not news. The fact that it's being covered in the news tells me something very strange. That is that so far, for the last 7 years, the NSA has been able to keep this out of the news cycle. They have been able to keep it out of the mainstream press. And you have some guy named Edward Snowden who's living on the other side of the country, or the world right now, hiding out. And they want to extradite him and get him over here. And he exposed and cracked open the fact that the United States is spying on all these other countries. They're spying on their own people. We have drones flying over our heads capable of taking us out. And the politicians don't want to debate whether it's okay, whether drones can kill American citizens, right? It's just, you scratch your head sometimes and you wonder where you are. And for those who listen to this program and think that the United States government, the federal government sitting in Washington, D.C., gives a rip, gives a rip about your privacy or about your rights, that's insane. That's absolutely insane. You get in their way, and they will do what they have to do. This is power. This is empire. And I know that's mature stuff. I know that there are many people in our audience who want to live in La La Land. They want to live in a fairy tale. They want to believe that America is so great, so fantastic. There's never going to do anything bad. They've never done anything wrong. And when they do, they always apologize, all this kind of stuff, right? That's insane. That is exactly the kind of setup that Hitler would have loved to have had. You have this much power concentrated in Washington, D.C., and then you have some guy like Hitler rise to it. The last thing we need. We have already seen with President Obama that the executive power through executive orders, the executive branch has way too much power. I mean, all the things that they can declare, and you put the wrong guy in that office, you put a Hitler in that office, you imagine what the United States now has in place would make Hitler drool. It would. He never could have dreamed of having this type of capability. That's why I'm concerned. I know that Hitlers are not just born in Germany. I know that they're not just born in Italy, like Mussolini. I know that they're not born just in Russia. They can be born in Terre Haute, Indiana, right? And they can climb to the presidency, and then they can exact their vengeance right there. That's why I fear for our country, because whenever we saw men get up on the presidential candidate platform and speak about liberty and speak about freedom, the things and the ideals that America holds so dear, and they were turned away instead to listen to the presidential candidates who used the most smooth words and wanted to please everyone and wanted to, focus on jobs and all of this. All those things are important. But the last thing that I want my president focused on is getting me a job. I want him to protect the borders. I want him to protect me. I want him to, regulate those things that the Constitution allows him to regulate. But I don't want him trying to get me a job, right? That's not the place for the president. That's not even part of the president's role. In fact, if you really want to go down the list and find out who that job belongs to, it belongs to the Federal Reserve. They're the ones who are mandated with maintaining, a good unemployment level, an acceptable unemployment level. And, I think everybody knows that they failed at that. And so the president is just kind of stepping over into that role. So you really just can't quit Facebook and quit Google and then think all of a sudden now nobody's seeing you, because they see you when you walk outside your house. If you haven't watched anything on drones or any kind of documentaries on some of this, I would encourage you to head over to our free website, ftmflix.com, FTM and then Flix, like Netflix. And it's just full of movies and documentaries that Jennifer and I watch, and you can contribute too. It's kind of a community, kind of like YouTube, where you can upload your own videos, but you can also just upload another video that you've seen somewhere else on YouTube, documentary, movie, or whatever. But go there and check out some of the movies we put up in the documentaries about this topic and educate yourself on really what's happening, because where we're heading is a very slippery slope. All right, let's look around the globe for a minute. China and Russia forces are starting a joint exercise. Again, this is something we've been keeping our eyes on. China and Russia have a long-standing division between them and a mutual distrust that goes way back. But it's almost as if collaboration is in their best interest today, as the BRICS nations begin creating their own bank, and they're trying to now, obviously create military integration. So we're keeping an eye on this. China and Russia starting joint exercises, military. They've been doing this for some time. In fact, you really want to go back. It's really started back in about 2007. But they're continuing these, and they're getting more and more integrated each and every year. Now, finally, I want to talk to you about real estate. Real estate is one of the asset classes that I strongly believe in, that people should be invested in. Having some stocks is good. Having some gold and silver is vital, I think, in these days. And having some real estate is extremely important. Your personal residence, obviously, is a very important holding, but also having an investment property or two or three or four because those allow you to protect yourself against inflation. They're inflation hedges. As inflation goes up, you can raise your rents. But let's just talk about mortgage rates for a minute. They're now over 4%. Now, if you have extremely good credit, you can still get somewhere in the vicinity of, 3.75, 3.8. But with worse credit, it's certainly above that. And the overall average rate for a 30-year fixed mortgage is now right at 4% as of the latest report that I'm seeing here. And rates have not been this high since April of 2012. So if you are in the market to buy a property, we all have no idea where mortgage rates are going in the near term. But certainly in the long term, we know they're going to go much, much, much higher. And our thesis has always been the same on this. If you're able to go in and purchase rental real estate and lock it in on a fixed rate at a low rate, well, as interest rates rise, you're going to be in a very sweet position as a landlord, because many people will not be able to afford a home as rates get out of control, which we expect them to. And you, with your fixed rate mortgage on your rental property, will be in a very, very healthy position. So the question becomes, where do you invest? Well, you can do a lot of research on this, but all U.S. real estate sectors across the board, whether you're looking at commercial, whether you're looking at residential, they are all looking like they're going to post gains in 2013. And even retail, according to the latest report from National Real Estate Investor, that even retail is going to be up. Retail has had a very difficult time, and you can think about this when you walk into the mall and you see many of the stores that are closed. That's a very difficult thing. I wouldn't want to own a mall in this current environment. I'd much rather own an apartment complex, and that's multifamily. You also have industrial real estate, things like, warehouses and manufacturing plants and whatnot. That's actually been a very good place to be over the last several years even, especially after the crash. Things got cheaper, but then it's been growing and been recovering very well. But multifamily property is the best, apartment complexes. But for an introductory type of play on multifamily, you can look at duplexes. You can buy a duplex, you can live on one side and rent out the other. Triplexes, or even a fourplex. Jennifer and I are looking at a fourplex right now up in Northwest Arkansas. Very attractive, and there are many different deals like that. Now, you know that I'm investing in Northwest Arkansas. That's where I've decided to plant. I moved up here from Houston. But Houston, by the way, is still a great market to invest in. So is Dallas in Texas. If you live in Florida, Orlando and Tampa are a great place to invest. If you live in North Carolina, Charlotte and Raleigh are a great place to invest. Minneapolis, where we've been several times with our Building True Wealth financial seminars, that is a great place to invest. Seattle is also growing very rapidly. If you're looking for bargains, some of the best places to go would be places like Detroit, Cleveland, Chicago. There are many different areas right now if you're looking for deals. According to, in fact, I was reading something. In fact, I have it right here. Interesting fact. According to Realty Track, here it is, I'm quoting, there are 51,000 potential foreclosure fixer-uppers nationwide, bank-owned homes that were built before 1960 and with an estimated market value below $100,000. So if you're looking for a low-priced home, they are very plentiful in the market. And real estate obviously has many, many, many benefits. I can't more highly stress the importance of looking into real estate right now, as I do believe that not necessarily capital appreciation is going to occur. I am not necessarily buying properties with the idea that they're all going to double in price. Instead, I'm buying them for steady cash flow and inflation protection. The same reason that I buy gold and the same reason I buy silver. Admittedly, real estate is not as easy as gold and silver. With gold and silver, you can just throw it in the vault, you'll throw it into your safe, and you're done. And it goes up over time with inflation. Well, with a rental real estate property, you're going to have to go out occasionally and do some stuff. In fact, especially if you buy a fixer-upper, you're going to have a lot of work to do. So before you leap, be sure to look, because there are some problems and difficulties in rental real estate. But I tell you, if you're not afraid of hard work, if you're not afraid of getting your hands dirty, if if you're not afraid of, putting in some really what they call sweat equity, then you can really walk away with a great deal and get yourself some good cash flow. Okay, before we head over to Tom Cloud, I've got a couple of questions from readers. Many came in. I'm going to try to get to as many as I can. First one is from Wyona in New York. The question is, did China and France drop the dollar as a reserve currency? If so, when? Thanks. Wyona, yes. China and France do have a swap agreement in place. It's a slow-moving thing. It has not fully taken effect yet. But yes, that is the goal. They are moving away from the dollar, and they're moving towards the yuan. In fact, China is focusing upon France as one of its primary footholds into the EU. France is certainly much more friendly to China than some of the other European countries. Okay, the second question I have here is, hi, Jerry, thank you for all the info you give us each week. I am starting in level 1 of your 5 levels of financial freedom, and my question is, should I still put 3% into my work retirement if level 1 is still not completed? Work does match my contributions by up to 3%. Thank you, Mario from Miami. Mario, yes. What we typically say is that if your 401k at work or your 403b provides a match, we always want to encourage you to take that match. So if they match up to 3%, dollar for dollar, or even 50 cents on the dollar, I would take advantage of the match. But above that, I would put that into other type of asset classes, maybe a different kind of vehicle, like a IRA, a Roth IRA, or something like that. But no, I wouldn't be piling a bunch of money into my 401k if I'm still in level 1. I would just meet the match. I think that not taking that match would be silly because it's just practically free money that they're providing to you. So yes, I would take advantage of that even in level 1 because 3% is not that much, overall. Hopefully you can also save another 3% and put it into liquid savings in a savings account and begin building up your 6 months liquid savings. Okay, and then finally we have a question from Blaise, and his question is, hi, Jerry, I am reading your book and it has led to many questions. How can the dollar fail if the Federal Reserve is in charge of the game and we are still on the petrodollar system? Well, that first question, we really can't. As long as the petrodollar system is in place, we're in pretty good shape. That really is the linchpin. Then he continues, gas in 2007 was $4 per gallon and a barrel of oil was $165. Today, gas is still $4 a gallon, but the barrel of oil only costs $93.50. Why is gas $4? Is there so much regulation on oil and gas in the USA because of the petrodollar system? The liberals push being green, but wouldn't their hearts really be in oil because of petrodollars? Great question, Blaise. And I want to explain the discrepancy between oil prices and gas prices really quickly. Why are gas prices high when oil prices are now in a relatively low place compared to where they were several years ago? Well, lower demand and higher supplies should lower prices. And we are seeing lower demand for gas because we do see these fuel-efficient cars coming out on the market. People are driving less. People are trying to save money on gas. So the demand is down. So you would expect with the supplies being up and the demand being down, you would expect to see the prices go down. The Northeast, for example, up in New England, New York, they're the ones with some of the highest gas prices. Much of the problem, not all of it, but much of the problem stems from the fact that much of the crude oil that's transported around the country is transported by way of rail. So they throw the crude onto a train, and it's very costly as compared to throwing it into a pipeline or sending it by ship, by water. Railway is a lot more expensive. So that's been part of the reason why we have seen this debate over the Keystone XL pipeline, which would basically split the country in half, all the way down from Canada all the way down to Texas, all the way down to the very bottom of the country. And this Keystone pipeline would certainly increase the efficiency, the cost efficiency of transporting, natural resources. So that's certainly what we have seen. Right now, for example, in Bakken fields up in North Dakota, if they want to take a barrel of oil and get it down to the Gulf Coast, they can't do that by pipeline. They can't do that necessarily by water. they have to use rail. And that, of course, is expensive. The same thing goes for the East Coast, and especially New England. So that's really what we're seeing. Also, remember that every gallon of gasoline sold in the U.S. is required to contain 10% ethanol, and that has reduced the benefits of cheaper oil prices. That's a subsidy of sorts. Oil refining, which is separate from drilling, is a very low-margin business. And so many times what we'll hear from the refiners is, well, gas prices are high because, our profits are low and we had to do this, we had to do that. I tell you what I really think it is, Blaise. It's greed. It's really just greed. I believe that greed plays a lot in the role of gas prices. And the fact that gas prices have not gone down, yeah, we can blame transportation. Yeah, we can blame other things such as ethanol. But when it really boils down to it, I really believe what we have here is greed. Oil and gas businesses, as much as I like them and as much as I like to invest in them, we must admit that there is a lot of greed that goes on in that industry, and I think that's a large part of it. All right, let's move over now to Tom Cloud and get an update on gold and silver in this week's Precious Metals Market Update.
Follow the Money Weekly presents your Precious Metals Market Update. Here's Tom Cloud.
Well, Jerry, things are getting a little more interesting, both as we look at the fundamental side of gold and silver and palladium in particular, and we look at the technical side. The technical side is still pretty boring and not very exciting. In fact, we've even seen this week that our palladium that's jumped 11% this year has kind of hit the wall at 780 and is consolidating a little bit back into the 750s, but we're still remain extremely bullish on palladium, but those that are worried should probably wait until we get into July, or at least the middle of July, to resume their buying if they're worried about a pullback. So I do want to get on the palladium, since we're having more questions about palladium than any other metal right this minute. I wanted to address that first. So if you are worried about a pullback, it's a good time just to sit still from a technical standpoint, but the fundamentals still point toward some kind of deal coming out of South Africa and Russia going together and marketing their palladium similar to what they did in diamonds about 15 years ago, that stabilizes the market. You don't get as much volatility. So keep an eye on it, but I would definitely not wait too long to get in palladium, because I'm expecting over a 10% jump the last 4 months of the year, which would be a pretty darn good return for 4 months. The key is just getting another entry point now that palladium has gone up $100 here in about 2.5 months. So gold is moving into what I talk about all the time, the seasonality of July, August, and September being the 3 months that gold over the last 31 years has gone up 3 months in a row. You only see that in those 3 months. I mean, certainly there are exceptions to that where other times it's gone up, but the ones that we have checked, and I'll be putting out an email on this before the end of July, but you want to get into gold sometime between July the 8th and August the 15th, because we're hearing from our European sources that the shorts are really coming down, and even Clive Mott on public sites this week has shown the gold and silver both doing that. He feels very confident that they're right at the bottom. But one thing, we do have a July 4th, 5th weekend where the market's closed for a couple of days, and I don't look for any major sell-off, but it could be a little weak into that. But starting Monday, July the 8th, our sources are telling us there's a lot of purchasing coming. We're starting to see the Indian buying pick up, and certainly the China New Year that'll come in the fall will also always brings increased buying. So your gold, you should be getting ready. It's not too early to buy now, but it's probably not going to do a lot from the technical standpoint, but the fundamentals are building up for an extremely, extremely good fall for both gold, silver, and palladium, and platinum for that matter. Silver is the one that continues to fight its bottom trench. Gold's about $70 clear of the 1320, where we have a lot of concern if it broke down below that, but silver is only about 50 cents clear of the 2150. So it's still a great time to just be accumulating ounces on that, and we have seen the premiums come back down as the mints, the U.S. Mint, Canadian, and Austrian have been able to get some new supplies of silver to meet the rising demand for coinage. So we did send out an alert this week showing a decrease in premiums for the first time in about 8 weeks. So that's also a good sign that the supplies are getting back a little bit. Still some delays, but not anywhere near what they were. But silver is something you're just going to have to watch, because when it moves, it's not going to move like 20 cents or something. So the ones over there worried about paying too much will end up worried about missing the boat. So this is one of those things you just need to get in, knowing that the dollar also, I've been watching and looking at graphs of dollar all morning. It does definitely look like a head and shoulders top, and I think that dollar will sell off into the 79.6 range by the end of the year, which is one of the reasons we're all predicting such a nice move for gold, silver, and palladium in the fall. So it's just keep an eye on that dollar. And then lastly, the other thing I wanted to mention is we're seeing a 30-year bull market come to an end in bonds, and certainly as money flees the bond market, and I have bond brokers I'm very close with and buy gold and silver, especially silver, have been calling me buying for their clients for the past 2 or 3 weeks, and that's increasing because when people leave the bond market, as yields keep going up and, of course, the principal of the bond goes down, this is going to be the norm, and just expect the rest of this year to continue to see the bond market get hit, and eventually you'll see interest rates across all sectors go up. So this will be the only way they can protect the dollar, whether they want to or not. They're going to be forced to raise interest rates. So that's going to be an interesting fall, Jerry, and we'll just keep doing this every week. But I think people enjoy the summer, but we're going to have quite the fireworks in the fall. And for those listeners that are new and are not on my email blast, they can go to fpmdaily.com and hit the precious metals button and sign up. We send out 2 or 3 email blasts a week, keeping our clients abreast of what's going on, and it's email addresses we don't share with anyone. They're completely confidential. And if you have any questions about gold or silver or how to get gold and silver into an IRA, you can reach me directly at 800-247-2812. That's 800-247-2812. And lastly, if you have rare coins, you're probably in the last few months of having a great chance to get over into bullion, because we expect bullion to jump and the rare coins to continue to have problems as collectors go away. And mainly rare coins are sold by telemarketers anyway to protect their high markups. So it's certainly not a good place to be, in my opinion, and we could talk to you about how to sell those and get into bullion coins, gold, silver, or palladium. With this week's Precious Metals Market Update, this is Tom Cloud signing out.
Gold, silver, palladium. If you have questions about or are looking to purchase precious metals, there is one name to know and one name to call. Tom Cloud at 1-800-247-2812. You hear Tom every week on Follow the Money Weekly, and gold and silver are an excellent hedge against inflation. Tom Cloud has over 30 years' experience as a precious metals advisor. Don't buy your precious metals through a call center and pay inflated prices. Call Tom Cloud, 1-800-247-2812. And for a limited time, tell Tom you heard it from Jerry Robinson on Follow the Money Weekly and receive free shipping and insurance on your order. That's right. Mention Follow the Money Weekly and your shipping and insurance charges are waived on your precious metals purchase. If you have a question about something you heard on the show, call Tom. And to secure your precious metals investment, call Tom. Your gold guy, Tom Cloud. 1-800-247-2812. That's 1-800-247-2812. You heard it on Follow the Money Weekly.
Jay Perrone, certified financial planner, here with the idea of the week. This week we'll take a look at an all-American stock that could be perfect for your retirement account. You save for retirement with the expectation that at some point you'll have enough savings to confidently walk away from the office and on to the next phase of life. It's been projected that the average employee needs to have nearly 16 times their salary saved by the age of 65. This is in addition to Social Security income in order to sustain their standard of living into their retirement years. So if you make $100,000 a year, you'd have to save at least $1.6 million to retire. Fidelity estimates show that the average 401k balance amassed by workers 55 or older stands at just $150,000. While the Employee Benefit Research Institute just released a report showing that the average IRA owner has an aggregate IRA balance of just $87,000. So it seems the average worker in America has a lot of catching up to do. This involves working with a competent financial planner, setting up a solid game plan, disciplined saving, and achieving solid gains in the years ahead. As I look for investment opportunities for my clients, I typically combine mature dividend-paying companies along with smaller companies that have the potential to explode. Take, for example, the all-American restaurant Cracker Barrel, ticker symbol CBRL. The stock is up over 50% in 2013. This is one of the small-cap stocks that's a part of our Tomorrow's Treasures portfolio. Even in a tough economy, there always seems to be a way to get a table at this restaurant. It prides itself in providing a friendly home-away-from-home atmosphere in its Old Country store and restaurant. The very first Cracker Barrel Old Country store opened back in 1969 in Lebanon, Tennessee, and it keeps things pretty simple. Its mission is to please people, nothing more, nothing less. It seeks to provide everyone who walks through its front doors with a warm welcome and a good meal at a fair price. Not only is the food good, but its stock performance over the last 5 years has been tasty as well, as it's averaged an annual gain of over 27% per year. This is the type of stock we look for in our Tomorrow's Treasures portfolio, smaller companies that can multiply our clients' assets and help them to make progress toward their retirement goals. This is a good buy up to $100 per share, and I expect it to continue growing at an annualized rate of 15% or more. Again, that's Cracker Barrel, ticker symbol CBRL, worth a closer look. So how close are you to retiring? A chat with a financial professional on this topic might be very illuminating. In discussing your current retirement potential, an answer to that question may start to emerge. Are you ready to retire? Is your current strategy sufficient? What changes do you need to make? If you'd like to discuss your options, give me a call at 866-594-9919. Again, that number is 866-594-9919. This is Jay Perrone, certified financial planner, signing off for the idea of the week. We'll see you again next week.
All right. Well, Jay Perrone is a CFP certified financial planner, a member of our Christian Financial Advisor Network, and he also manages our very own PACE investment portfolio. If you would like to have a 30-minute review of your investments with Jay, you can call him at 888-664-6963. That's 888-664-6963. And when you do, be sure to tell him you heard about him on Follow the Money Weekly Radio.
How can you find tomorrow's most profitable stocks before Wall Street finds them? Well, many investors are searching for a place to find stocks that can turn a nest egg into a huge fortune. Since 2009, the Tomorrow's Treasures portfolio has produced annualized gains of 28%, turning a $10,000 portfolio into $21,300. Small cap stocks have had an impressive run over the past 87 years. In fact, small cap stocks have produced 12.1% annually compared to just 9.9% for large cap stock, according to research. Now, this may seem like just a measly 2.1% each year, but the compound effect over the years is astonishing. Consider this, $10,000 invested in large-cap stocks in 1926 would be worth $30 million today. Pretty impressive, right? But $10,000 invested in small-cap stocks in 1926 turns into over $160 million. Simply put, if you want to build a fortune over the next decade, you must invest in small-cap stocks. In fact, all of the top 10 performing stocks of the past decade were small-cap stocks. Chances are the top performing stocks over the next decade will also be small-cap stocks. So how can you build a fortune? Well, there's no get-rich-quick formula, but good old-fashioned discipline, hard work, and a thorough screening process can pay huge dividends. That's why the Tomorrow's Treasures portfolio was created to help you find the best small-cap stocks today. By investing in underfollowed companies before Wall Street analysts catch on, you can stand to make substantially higher gains as the market drives up share prices. Get started today. Learn how to crush the markets using small-cap stocks. The Tomorrow's Treasures portfolio service may just be what you're looking for.
All right, where's my money?
Money.
Daily bread.
Follow the Money Weekly presents the Retirement Minute.
Hello, everyone. This is John Burse with this week's Retirement Minute. In talking with many people that are preparing for retirement, the statement that comes up the most is whether or not Social Security will be there when they need it. So I thought over the next couple of weeks that I would share some myths and facts about Social Security. Here's the first myth. Social Security will provide most of the income you need in retirement. Well, the fact is, it's likely that Social Security will provide a smaller portion of retirement income than you expect. There's no doubt about it. Social Security is an important source of retirement income for most Americans. According to the Social Security Administration, more than 9 out of 10 individuals age 65 and older receive Social Security benefits. But it may be unwise to rely too heavily on Social Security because to keep the system solvent, some changes will have to be made to it. The younger and wealthier you are, the more likely these changes will affect you. But whether retirement is years away or just around the corner, keep in mind that Social Security was never meant to be the sole source of income for retirees. As President Dwight D. Eisenhower said, this system is not intended as a substitute for private savings, pension plans, and insurance protection. It is rather intended as the foundation upon which these other forms of protection can be solidly and soundly built. No matter what the future holds for Social Security, you should focus on saving as much for retirement as possible. And there are many good ways to save for your retirement, but make sure you use investments that meet your criteria of what you want it to be able to do for you when you retire. When combined with your future Social Security benefits, your retirement savings and pension benefits can help ensure that you'll have enough income to see you through retirement. For most Americans, Social Security is an important part of your retirement planning, so make sure you understand the difference between myth and fact. So make sure your financial house is in order by contacting me at 888-914-9909, and I will be more than happy to review your financial situation with you.
All right, friends, well, that brings us to the end of our program. Thank you so much for tuning in once again to this program. It really is an honor and a privilege to have you here each and every week with me. I want to leave you with a final word and a final thought. First, I want to tell you that if you don't have a will, it's a good time to go get your will drawn up. 70% of Americans do not have a will currently. If you have dependents, children, or if you're married, no matter how little, how much you have, it's really a good idea to have all of your wishes in writing. And also, you want to make sure that you have your power of attorney in place and your advanced health care directives. I would urge you to meet with an attorney in your area this week or next week if you do not have a will and get that process started. It really will be a blessing to those around you in the future. And I want to leave you with this final word. This is Luke chapter 6, verse 38, the words of Jesus when he said, "Give, and it will be given to you. Good measure, pressed down, shaken together, and running over, will be put into your lap. For with the measure that you use, it will be measured back to you. Just something to think about. Remember, friends, when you want the truth about the global economy, just follow the money. Have a safe and prosperous week, and I'll see you right back here next weekend. God bless.
The views and opinions expressed by the guests on Follow the Money Weekly do not necessarily represent the views of FTMDaily.com or Makers Group Financial, LLC. Even though these are proven strategies, Jerry Robinson is not a financial advisor, and his guests are not legal or tax advisors. You should always consult a trained financial advisor and or tax advisor before making any financial decisions. John Burrs is a registered representative of and does offer securities through Sycor Securities Incorporated. Lifetime Decisions Management Incorporated is not a subsidiary of nor controlled by Sycor Securities Incorporated.